Okay, hello everyone, guys. Hello, how are you all? Hello, good evening. Hello, guys, how are you all? Good evening, everyone. Good evening. Just please comment once about the audio and video of the class. Is everything is working good, working fine? How are you all? Where are everyone? Audio, video, everything is clear, working fine with everyone? Yes or no? Okay, so hello everyone. Hi guys. So we already have discussed part 1 of module B, right? So in this marathon session, we are studying the module B completely into marathon session. Part 1 we have finished on Monday and part 2 we are finishing today, right? So the objective behind this marathon for all of you is that I am just going to give you whatever the information that I want to provide you on this particular module. Rest every video is given to you in the recorded format, right? So it is my efforts to all of you that you will be very well aware of what is module B, what is all about module B, the important topics of module B, right? So this I am just going to cover in this modules, right, everyone? So I hope that everything is clear. Audio is clear, video is clear, audio is working fine, video is working fine with each and everyone. Whoever is watching this video, just kindly comment once that audio, video, everything is clear, working fine everywhere. Yes or no? Everyone? Okay, so can we start the session? Okay, so can Okay, so let's start with this contract of indemnity. The very first thing is this contract of indemnity. What is this contract of indemnity? See, contract of indemnity is actually defined under Section 124 of Indian Contract Act 1872. And what is contract of indemnity? Where there are two parties, like for example A and B, where one party promises to another party that if you suffered any loss from any third party or from anything, then your loss will be compensated by this party. So the contract between these two is called as the contract of indemnity. All insurance contract except the life insurance contract are termed to be as the contract of indemnity. For example, when I am taking insurance, so obviously that insurance company is actually promising me that if in case that I suffered loss from any third party, then my this loss has been covered by the insurance company, right? So this is called as the contract of indemnity, right? The one person who is promising to indemnify the loss is called as indemnifier. In this example, A is called as the indemnifier. B is the indemnity holder. Indemnity holder, or you can say the person who is indemnified, right? So there is an two parties in contract of indemnity: indemnity holder and indemnity or indemnifier. Okay, and all insurance contract except the life insurance contract are come to be as the contract of indemnity. Now, when we are talking about the indemnity contract, okay, so what are the features? First of all, there are two parties. There are only two parties in the contract of indemnity: the indemnifier and the indemnified person, right? Next, if we talk about the contingent risk, Okay, what are the risk? So the risk is contingent, where in the guarantee the liability is subsisting. So here there is a difference between indemnity contract and guarantee. So when we are talking about the contract of guarantee, so in contract of guarantee there are three particular parties. One is the principal debtor, one is the creditor, and one is the surety. Surety gives a guarantee on the behalf of principal debtor to the creditor, that if debtor is unable to pay the money, that I will be responsible for paying you the money, right? So two parties in contract of indemnity and three parties in contract of guarantee. Contingent risk, if we talk about the indemnity, the risk is contingent, whereas in guarantee the liability is subsisting. Now what it is trying to say, contingent risk means the indemnifier's liability only arises when the loss incurred. So, as soon as the loss incurred, then only the liability arises. So, if there is no loss, there is no liability of the indemnifier. That is called as contingent. Okay. But in guarantee, the liability is parallel. Okay. So, if that principal debtor has actually the repayment of 5 years, okay, so the liability of that surety is for that complete 5 year. They are going parallel, they are subsisting with each other. So the guaranteed liability exists as long as the debtor fails to repay the payment, right? But in contingent risk, the risk only arises when the indemnifier or when the loss actually occurs. So that is the risk nature. Now in the third thing is nature of liability. In contract of indemnity, the indemnifier's liability is actually the primary one. Okay, means as soon as the loss occur, so the indemnifier has to step in and just compensate the loss, because the indemnifier has promised to indemnify it, that I will be covering up your losses. So in that case, they don't have to wait for any third party, that okay, first you have to give the proper consent, and first you try to compensate the loss. If you cannot compensate the loss, then I will compensate the loss. This is not the matter in the indemnity contract, because indemnity contract says that the loss will be as soon as the loss occur, right? As soon as the loss occurred, okay, here the indemnifier has to step in and compensate the loss. Whereas if we talk about the guarantee, in this guarantee, principal debtor's liability is primary, right? Means first the debtor has to make the payment, and if debtors default on payment, then there is the surety who has to make the payment. So surety's liability is secondary, while debtor's liability is primary, right? Number of contract, there are only two parties in the contract of indemnity, and that's why there is only one contract between the indemnifier and indemnified. Whereas in contract of guarantee, there are three particular contracts between the debtor and creditor, between creditor and surety, and between the surety and the debtor. Now what are the purpose of the contract? Indemnified or indemnity, the purpose is for reimbursement of the loss, whereas the guarantee is actually given for the security of the creditor. And when we are talking about the contract of indemnity, it can be expressed or it can be implied, right? So this is the difference between indemnity contract and the contract of guarantee. Hi Hema, good evening. Good evening, Hema. Just please try to take rest as uh, much as you can. Don't just uh, uh, don't just be tensed about this lecture. Okay, you have this lecture in the recorded format, and I am there. If you have any doubt, you can just message and call me, right? But in this 103-degree fever, you need to take rest as much as you can, right? So it's my recommendation, just please try to take rest. Okay, Shirish, hi Gopal, hello everyone. Happy Holi to all of you. First of all, a very happy Holi to all of you, right? And I hope that now the Holi is finished and you are back to work, everyone. So I was telling you about the difference between the indemnity contract and the guarantee. Now next, let's talk about the implied or implied indemnity. Now, what is implied indemnity? Now, for this, I'm just going to give you a very short example, right? For example, there is a person A, okay, for just mm, uh, specifying this implied indemnity, I'm just giving to you a very short example. For example, there is a person A, okay, and A hire a, for example, contractor to build a fence outside their house, right? And A hire, for example, B as a contractor to build a fence which is actually outside their property. B just built this fence and followed the complete instruction of A, right? Whatever A has said that you have to build this fence like this and this and this and this and in this area, B just completely followed the instruction of A and just actually built a fence here. Okay. Now, this fence is actually touching or just interfering in the road, for example, right? Now there is a person who is coming, okay, because this fence is touching the road. This person just fell off from this fence and he suffered an injury, okay. Now there is that person name is, for example, C. Now once the C suffered some injury, C goes to B and says that you have built this fence and I have suffered this injury, kindly just compensate me for my loss. Now, because B has built this fence, so B has to compensate the loss of C in this case. So B have to give compensation to C for this injury. But now here it is the implied indemnity of A that you have to give compensation to B. For example, B have given rupees 10,000 for as a compensation to C because C fell off and has suffered some injury here. Okay, because B has built this fence, but B has completely followed the order of A. Okay, so it is the implied indemnity of A that A has to compensate this rupees 10,000 to B, whatever the amount B has given to C as a compensation. So it is called as the implied indemnity. Clear? So this is a very simple example of implied indemnity, right? Now this is the contract of guarantee. Now if you have any, sorry, contract of indemnity, if you have any doubt in this chapter, you kindly ask everyone. So I'm just giving you a very quick revision of each and every unit in this module B, right? So in detail, you have the recorded videos. Okay, you can just see that recorded video and you are good to go. But from my side, I just want to explain and give just a quick revision of the complete module B. Okay, now if you have any doubt, Shirish, Hema, Gopal, and everyone, if you have any doubt here who is watching this session, kindly just ask me your doubt. Everyone. No doubt, everything is clear. Gopal, Shirish, so only Gopal and Shirish, you have to comment, okay? Hema, you just please take a rest. You just listen whatever I'm just telling you, right? No doubt? Okay, good. Now next. Next is the contract of guarantee and what is the bank guarantee, right? Now, first of all, let's talk about the guarantee. So guarantee is actually a contract, or you can say it actually a promise to discharge the liability in case the debtor default. Okay, so for example, there is A, there is B, and there is C. A has given 50 lakh rupees as a credit to B. And because the amount is very substantial, A want a guarantee from B or from B side, from any third party, that if you default on payment, then on behalf of you, there should be anyone who is just giving back the money. Now C is a friend of B, for example, right? Now C gives guarantee to A that in case this B default on payment, then I am responsible for making the payment. Now this is called as the contract of guarantee. Where A has given money to B, so A is called as what? A is called as the creditor. Now B is the principal debtor because B is responsible for giving the money, right? And on behalf of B, C is giving the guarantee. So C is called as the surety. So this is called as the contract of guarantee. And in contract of guarantee, there are three parties: creditor, debtor, and surety. Now, once this is bank, When the surety is particularly coming from a bank, means instead of C, on behalf of B, B's bank is giving guarantee to A that if B defaults on payment, then I am responsible for making you the payment. Now, when the guarantee is coming from the bank, then the same thing is called as the bank guarantee. In bank guarantee, there is only one difference, that the surety should be a bank, right? So there is a bank guarantee and there is a normal guarantee, right? Now, when we are talking about the continuing guarantee, now what are continuing guarantee? So when we are talking about the continuing guarantee, which is actually extended to a series of transaction, it means that when the guarantee is actually given for a series of transactions, for example, there are A and B, importer and exporter, they are continuously engaged in the transactions, right? Now, on behalf of B, the bank is giving guarantee for the complete series of transactions to A. Now, this is called as the continuing guarantee, which is actually extended to whole transactions or to a series of transactions, and it is not limited to one transaction. Right? Now, variance in terms of contract. See, if there is any modification when there is a contract between the creditor, the principal debtor, and there is a surety. Now, if there is any changes in the contract between A and B, because A is a creditor, B is a debtor, and A has given money to B, B has to repay back the money. Now, if for example there is any changes in the contract between A and B, okay, and this is without informing the C. With it, without informing the C. Now, in this case, C is discharged from any type of liability. C can be discharged from the surety if the changes is done without the consent of the surety, means they just change the contract within themselves, and a guarantor, they does not involve the guarantor. In this case, guarantor doesn't give the consent, okay, and so in this case, without the consent of guarantor, when the modification has been done between the contract of A and B, then in this case, C or the surety should be discharged from the any type of liability, and this is according to section 133 of Indian Contract Act, right? Next, security. Now, security, a surety is entitled to the same benefit which the creditor has to the principal debtor. It means that, for example, A had A given loan to B, and B has given some collateral, okay, to A, okay, for securing this loan. This collateral is applicable to C also. For example, if B defaults on payment, and in this case, A just sold this collateral in the market and recovered some amount of money here. Now, the same money is applicable to C also. For example, the debt is of 1 lakh. Okay. Now, A just sold some collateral, and from that selling of the collateral, 40,000 money has been recovered. Now the original due is only 60,000. So now C is also responsible for paying only 60,000 to A, not the whole 1 lakh. Because whatever the collateral and the guarantee which has been given by B to A, if there is use of any that thing by the creditor side, that same is applicable to the surety also. Okay. Now, imply the promise by the principal debtor to indemnify the surety. This is very simple. Now, B on behalf of B, C is giving guarantee to A that if B defaults on payment, then I am responsible for paying you the money. Now, C is what? C is not your father. C is not your mother, that who is just doing anything without any intention of coming back. No, C is here, and if C is providing you the guarantee on behalf of B that I am responsible for paying back you the money, then it is the implied promise from B to C that whatever money you are giving to A, I will be indemnifying that money in the future. For example, C has to give 60,000 rupees to A in this case. Now, it is the implied promise by B to C that I am going to cover your 60,000 in the future. And that's why when the C is giving guarantee on the behalf of B to A, so it is an implied promise by the debtor to the surety that I am compensating you the loss. Okay, this is according to section 145 of what? Of the Indian Contract Act. Now, co-sureties. Now, co-sureties means, for example, there is two or more person who are giving guarantee for the same debt. For example, there is A, there is B, and now there is three surety in case of B. Means on the behalf of B, these three are the sureties who give guarantee to A that if B defaults on payment, we will be responsible for paying. Now, if B defaults on payment, then it is the liability of all three guarantors that they have to what? They have to cover the liability of A. Right now, for example, the debt is of rupees 30,000, so they have to pay according to the ratio they have set within themselves. For example, if they have said 2 is to 1 is to 1 ratio, then this ratio. And if there is no ratio that has been set, so all the three is responsible for compensating the amount equally to A, like 10, 10, and 10,000. So these are the co-sureties for the same debt. Now, release of one surety doesn't discharge an other. It means that, for example, there is three guarantor, okay, and there is A who has given loan and there is B. Now B defaults on payment. Now they have 10,000 liability each that they have to pay to A. Now, for example, this A sees that there is a person D. There is a person D who is actually in a very financial stress, and due to which A decided to just what? Just releases D from their liability. So if D is released by A from the liability due to any reason, it doesn't mean that C and E is also released. No. C and E, they both have to make the payment of rupees 10,000 and 10,000 to A. But A exclusively discharges D from their liability due to any reason. So, if there is a release of any one co-surety in this case, it does not discharge the other sureties from their liability. They have to make the payment. Clear? So, they have to make payment carefully. Now, when we are talking about the bank guarantee, Shirish, does co-surety have some agreement to pay in percentage? Yes, they can have the agreement. They can have the agreement and they cannot have the agreement. Both can be the cases. If they don't have the agreement, then they have to compensate equally. If they have the agreement, then they have to follow for whatever percentage they have set in that agreement. Okay. Now, next is the bank guarantee. The same thing is when the A is giving loan to B and B is promising to pay A. Now the amount is very substantial. So A want a guarantee, a bank guarantee. It means that on behalf of B, B's bank is giving guarantee that in case B default on payment, then B will be responsible for paying to A. Now, because the surety is coming from the bank, then it is called as the bank guarantee. Now, bank guarantee can be financial, can be performance, can be deferred payment guarantee. Now, quickly, financial guarantee means this particular example. A has given loan to B, B has to make payment to A. Now, bank is giving guarantee on behalf of B to A that if B defaults on payment, then we are responsible for making you the payment. This is called as financial guarantee. Very simple, right? Performance guarantee. Performance guarantee, for example, A hire B for building a bridge. A hire B for building a bridge. Okay. And the time period set between these two is for 6 months. That A has said that you have to finish this bridge in this 6 month, right? Now, because there is a very big amount that is involved in this particular thing, and there is a proper timeline which has been given by A to B that you have to finish this bridge within 6 months. Now, here, A wants a performance guarantee on behalf of B. A said that, for example, if you are unable to build this bridge in 6 months, then on behalf of you, your bank should be providing me a performance guarantee. It means that if you are unable to perform within 6 months, then on behalf of you, your bank is responsible for paying me rupees 50 lakh. If you are giving me this guarantee, then only I am giving you the contract, right? So now B has to make this. If B want to have this particular contract, B just goes to a bank and says that you have to give a performance guarantee to A. It means that if B is unable to build this bridge in 6 months, then on behalf of B, because he fails in the performance, so on behalf of B, B's bank is responsible for making A some payment. This is called as the performance guarantee. And deferred payment guarantee, it is for the deferred payment system. For example, A has sold some machinery to B, and B is actually, instead of the immediate payment, B just distributed that amount in a period of 2 years, which is paid into a monthly installment. Now B is paying monthly installment to A, but A want a deferred payment guarantee. It means that on behalf of B, B's bank should be giving guarantee to A that if B defaults on any EMI, then that EMI will be fulfilled by the bank. Then it is called as the deferred payment guarantee. Okay, so this is the bank guarantee. Now, if you have any doubt here, kindly ask everyone. Any doubt? If you have any doubt here, kindly ask your doubt. And if you don't have any doubt, just please give me a thumbs up. Okay. There is no difference between first and second, it seems. How does they differ? Yes, there is a difference, Shirish, between the performance guarantee and financial guarantee. Financial guarantee is for securing the debt. In case A is giving loan to B, B has to make payment to A, but on behalf of B, bank is providing the guarantee. Performance guarantee is actually for executing a particular task. Here, there is no loan that is given by A to B. There is a task which has been given by A to B, that you have to build this bridge in 6 months. And if you are unable to do so, then on behalf of you, your bank will be responsible for paying me 50 lakh rupees as a performance guarantee. There is no debt, there is a particular task that has been given, and for which there is a performance guarantee. Okay, bank cannot complete that bridge. Bank is just there for B, that if B is unable to complete that bridge, bank has to make payment as a guarantee to A. That because A, for example, has suffered some loss. So on behalf of B, bank is paying 50 lakh rupees as a performance guarantee to A. Because B haven't performed. Okay, B is not able to fulfill that bridge. Bank don't have to build or complete that bridge. Bank just have to give performance guarantee on behalf of B to A, that yes, B is unable to do this task in 6 months, so I am responsible for paying some money to A. That is the performance guarantee. Okay, done. Any more doubts? If you have any more doubt, kindly ask everyone. Any more doubt? Shirish, Gopal, Ruchi. Hi Ruchi, good evening. Happy Holi. Hi Ruchi, good evening. What will happen the work of building bridge then no work is happened. For example, A has received the compensation of 50 lakhs because B is unable to build that bridge. Now it is up to A. They can extend the contract to B, means the same party, okay, to build that bridge. But for example, A is not satisfied with the bridge. It just end this agreement with B and just hire another party to build that bridge. Okay, done, Shirish? Clear? Everyone. Any doubt, please ask your doubt. If you still have any doubt, please feel free to ask your doubt. I am just going to tell you everything. If you have any doubt, no matter how many times you are asking, I am just answering your doubt if you are asking. Okay. So just please ask. Gopal, Shirish, Ruchi, Hema, everything is clear till now. Yes or no? No doubt. Now let's talk about the letter of credit. Okay, now what is letter of credit? I just switch off the camera because I want this space to give you the what the letter of credit explanation, right? For example, letter of credit. First of all, the letter of credit is actually for executing some import and export transactions. So when there is an import and export between two countries or between two enterprises which are located in two different countries, because they don't often involve in a trade, so there should be a letter of credit. There is a letter of credit which is actually acting as a guarantee for executing the import and export. Okay, now what is this letter of credit? For example, imagine there is a two company. Okay, for example, there is ABC Limited, which is actually a US company, right? And there is XYZ Limited, which is a Chinese company. Now this ABC Limited wants to buy 1,000 in smartphones. For example, this ABC Limited wants to buy 1,000 phones from XYZ Limited. Okay, because there is an import and export. So ABC Limited want to import 1,000 phones from XYZ, which is actually the exporter. So this is actually working as an exporter here, and this is working as an importer here. Right? So they want to buy, ABC want to buy, XYZ has to export 1,000 phones to ABC Electronics. Now, to ensure that the transaction should be executed safely, okay, XYZ wants that, or XYZ just demanded from ABC Electronics that you have to give me some guarantee that you will be paying for this transaction, because we don't involve in trade so much. I am shipping you 1,000 phones, then what is the guarantee that you are paying me the money? Okay, so XYZ just demanded that, because I am new to this trade, you please provide me some guarantee. Okay, so that I just give you the what smartphones, and you just give me the trust that you will be paying this money. Okay, so to give this XYZ Electronics, Chinese company, confidence, this ABC Electronics just go to their bank. Okay. For example, this is a US bank. Okay. So ABC Limited just goes to their US bank and asks them that please issue a letter of credit. Please issue a letter of credit in which every detail of the transaction, like amounts and terms of conditions, should be written carefully. Now, this US banks just issue a letter of credit and send it to this this exporters bank, which is, for example, Chinese bank, right? So they just issue, this US bank, this importers bank just issue a letter of credit and send it to Chinese bank. And this letter of credit has all the details of the transaction. That what is the amount that is involved in this transaction, what are the terms and conditions for this transactions, right? Now, this letter of credit also states that if everything is executed as per the terms and conditions which are written in the letter of credit, then US bank will be responsible for making payment to the Chinese bank. Okay, if every condition is mentioned. Now, after receiving this letter of credit, the China, means this exporter, has actually shipped the smartphones, 1,000 smartphone to ABC Limited. Okay, now when they ship the 1,000 smartphones to ABC Limited, all the proof, of shipping this smartphones, like the bill of lading or anything, everything Chinese, this exporter has actually submitted to Chinese bank. Okay, now, Chinese bank review the all documents, ensures that yes, this XYZ Limited has executed or shipped the transactions carefully and they matches with the letter of credit condition. And once the Chinese bank has been satisfied, China bank send these document completely to US bank. Okay. Now US bank verifies the document, and when everything is good, US bank make payment to Chinese bank, because that is written in the letter of credit that if the transaction has been executed as per the conditions which are mentioned in the letter of credit, then US bank will be responsible for making the payment to Chinese bank. Now, once receiving every document, the Chinese bank verifies and send it to US bank, and US bank verifies and everything is good, and US bank makes payment to Chinese bank, right? Now, Chinese bank then pays to this exporter. Now, this exporter receives the payment. Okay. Now, once this ABC Limited received this 1,000 phones delivery, after receiving delivery, ABC Limited just pay back to US bank whatever the money US bank has paid back to China bank, right? So this is called as the letter of credit, and this is how the transaction is executed in the letter of credit. Don't worry, Shirish, this will be discussing in the further slides that what are the documents that are required for the letter of credit transaction. So there are different documents like the invoices, like the bill of lading, okay, like the transport, like the courier. These all will be in the coming slides. Don't worry. So this is called as the letter of credit. Letter of credit, the difference between letter of credit and a guarantee is actually the thing. Bank guarantee is usually given when there is a transaction within the domestic boundary. But letter of credit is actually issued when the transaction is between the exporter and the importer. So there is an exporter, there is an importer. Always remember, importer has to ask their bank for issuing the letter of credit. So who issues the letter of credit? Importers banks always issues the letter of credit on the request of importer, right? Now there are four parties necessarily in the letter of credit. There is an importer, there is an exporter, there is an importer bank, and there is an exporter bank. So these are the four parties which are necessarily to be in the letter of credit. Okay. Yes, letter of credit is issued by the importers on the request of importer by the importer bank only. Yes, Ruchi. Okay. Now, these are the parties which are involved in the letter of credit. First of all, there is an importer who is also called as an opener, applicant, or the buyer. Okay, importer is called as the buyer, that you all know. Why he is called as the opener? Because he is the one who just issue or who just request their bank that they have to issue the letter of credit. So letter of credit is issued by only the importer's bank on the request of the importer, right? And there is an issuing bank which is also the importer bank, okay, which actually issues the letter of credit. There is an exporter, okay, you see that there is an exporter, okay, who is actually receiving the benefits of this letter of credit. Now, there is an advising bank. So, advising bank is actually in the exporter's country, where the letter of credit is advised to the beneficiary to rely that it is authentic and genuine. So, this notifying bank, okay, it is not compulsory that in every situation there should be a notifying bank. No, sometimes, because the exporter is not satisfied with one bank, so exporter wants to add an extra layer of guarantee, and for which the exporter just request one more bank to just confirm or to just authenticate this letter of credit that it is genuine or not genuine, right? So that is the work which is actually given by the advising bank. There is a negotiating bank also. Negotiating bank again in the exporter country. okay, which actually settle out the payment or negotiate the bill. It means that, for example, this all transaction needs 2 months, okay, but the exporter want immediate payment. Now exporter just goes to a bank which is called as the negotiating bank, and just do what, negotiate the bill. Whatever the bill they have, whatever the letter of credit they have, they just hand over the letter of credit and the bills to this negotiated bank and receive immediate payment from their side. Okay, so this is again not necessarily to be in every condition. Why? Because negotiating bank, the work of negotiating bank is to provide immediate money to the exporter if exporter want it, right? There is a confirming bank. Confirming bank is extra layer again to the advising bank. It means that the confirming bank adds on the guarantee that, for example, if this bank fails to make the payment, then I am responsible for making the payment. So advising bank is actually for providing again an extra layer of security to the exporter. Okay, if the exporter is not satisfied with the issuing bank, if the exporter is not fully confirmed with the advising bank, they just want to have an extra layer of guarantee. What is the extra layer of guarantee? They just say that if, for example, this particular bank is not able to make the payment, then I am responsible for making the payment. That is the confirming bank. And reimbursing bank is appointed by the issuing bank to make the payment. Okay, for example, sometime in a different scenario, this US bank, means importer bank, just appoint another bank in the exporter's country to make payment on behalf of this US bank to the exporter. So that is called as what? That is called as the reimbursing bank. Okay, so there is an applicant, issuing bank, beneficiary, and advising bank. These are actually in every condition. Okay, negotiating, confirming, and reimbursing bank, these are just like an extra layer of security. Negotiating bank is just for negotiating the bill, okay, which comes in that scenario when the exporter wanted immediate payment. Confirming banks add on an extra layer of security. Reimbursing banks, sometime the issuing bank just appoint another bank in the exporter country to make payment on behalf of the importer's bank, right? So these are not necessarily in every condition, but these four banks are present usually in all the transaction. Usually, why I'm saying that usually? Because sometimes instead of these four, there are only three parties which are present in the letter of credit. Okay, so ma'am, first four again, please, ma'am. First four means these four. So these are the importer who just want to what? Importer just to the request the importer bank to issue the letter of credit. So in this case, the importer is ABC Limited, right? Now issuing bank is the US bank. Importer requests the US bank to issue a letter of credit. So US bank is the issuing bank. Okay. Now Chinese bank is the advising bank. Chinese bank is the advising bank who just advise different terms and conditions for executing the transactions. And there is an exporter which is called as the China, okay, or XYZ Limited. Okay, so these four are usually in every transaction. Sometimes there are only three in a transaction, sometimes there are four in transaction, but these three are different. These three comes in different scenario. Okay, done. Now there are different types of letter of credit. Now first of all, there is an acceptance credit. Acceptance credit, it means that the letter of credit where the issuing bank, upon accepting a draft from a seller, guarantees a payment at a future date. Means here there is an acceptance credit which says that the bank, means the issuing bank, for example in this case this US bank, just don't make the payment immediately. Issuing bank says that if every transaction, everything is executed as per the terms and conditions which are mentioned in the letter of credit, then US bank will do what? US bank will make payment after 30 days. Okay, so issuing bank just take some time period that I will be making you the payment at a future date. That is called as an acceptance credit. Irrevocable credit, it means that the letter of credit cannot be cancelled or it cannot be changed without the consent of the beneficiary. Okay, that is irrevocable credit, means it cannot be amended, it cannot be cancelled. Okay, now there is a confirmed letter of credit. Now what is confirmed letter of credit? Where there is an extra layer of security which is called as the confirming bank. I have said that this is not present in every scenario where their exporter want to have a extra layer of guarantee, appoints the confirming bank that if, for example, issuing bank is not able to make the payment, then you are responsible for making the payment. Now when this extra layer of guarantee is added, then it is known as confirmed letter of credit. Okay, now there are transferable credit. Now what are transferable credit? Transferable credit means those letter of credit which can be transferred to the third party. It means that the letter of credit, in the letter of credit, the exporter is entitled to receive the payment. Now the exporter just transfer this LOC to another name, that on behalf of mine, you are responsible for receiving the payment. That is called as the transferable credit. When the LOC is transferred or when the exporter is actually transferring his right of receiving the payment to any third party, or you can say the second beneficiary. That is called as the transferable credit. Now there is a back to back credit. Back to back credit in which the letter of credit issued uses the same to open another letter of credit with his favor to the supplier. For example, that a particular in a particular situation or in a particular circumstances, ABC and XYZ want to execute a transaction again in the future. Beneficiary, Shirish, who is beneficiary? Tell me, who is entitled to receive the payment in letter of credit? Just tell me, who is entitled to receive the payment in a letter of credit? The exporter. Exporter wants payment now, so exporter is a beneficiary. In a letter of credit, when I am saying that beneficiary means the one who is entitled to receive the payment, and who is entitled to receive the payment? Exporter. So exporter is a beneficiary, right? Clear? No, it is not the importer bank. Importer bank is issuing the letter of credit. Yes, okay. Now, when we are talking about the back to back credit means when the importer and exporter they want to execute again the transactions. Okay. Now, in this case, for example, importers bank issues a letter of credit to the exporter. Now exporter has to give 1,000 smartphones to importer. Now for example, exporter want to take that smartphone from another party which is actually located in, for example, Germany. Sometimes this happens now, this is actually serving as an intermediary. So another this want another means this wants again that 1,000 smartphones they want to give it to him, right? But they want to take the 1,000 smartphone from another party which is located in Germany. So if they, in this case, the importer's bank has issued a letter of credit in favor of exporter, and the exporter is using the same letter of credit for securing the transaction or for securing that particular product from this company. Okay, then this is known as back to back credit. Means this is providing LOC to this, and the same LOC is providing as a guarantee to this case also, right? That is known as back to back credit. Okay, anticipatory letter of credit. Now, what is anticipatory letter of credit? In which there are two things, red clause and green clause. In the red clause, if there is a red clause in the letter of credit, it means that The beneficiary means, who is the beneficiary? Exporter. The exporter is entitled to receive some advance payment before shipping the products. So in case the exporter have to ship the 1,000 smartphones to importer, but before shipping, if the exporter is entitled to receive some advance payment from the importer, then it is called as the red clause. And green clause, in green clause, the exporter is entitled to receive the advance payment plus any extra charges, like for example the shipment cost or the storage cost. So it is not only, the exporter is not only entitled to receive the advance, but also entitled to receive some extra cost like the storage cost or the shipment cost. Okay, then it is called as the green clause. And the revolving letter of credit, when the same letter of credit is actually acting as a guarantee for the future transactions also, means A and B, they are executing the trade after 6 months also. So the same letter of credit is again used for the future transaction. That is known as revolving letter of credit. Okay, so these are the different types of letter of credit. Now, what are the documents that are needed to the letter of credit? Now, Shirish, what you have asked is actually written here. Sometime bill of exchange, invoice, transport, bill of lading, airway bill, insurance document, other documents. So these are some of the documents which are needed in the letter of credit, right? So this is the complete letter of credit. I have just given you an explanation under 15 to 20 minutes, but I have given a very detailed discussion of letter of credit in the video of 1 to 1.5 hours, right? I've taken time, different examples to give you the explanation of these letter of credit. So kindly, for detail, see that video. Okay, now if you have any doubt here, please feel free to ask your doubt. Everyone, any doubt, guys? Ruchi, Shidish, Gopal, Hema, everyone, if you have any doubt, please ask. Shirish, okay, no issues. But I will be completing this deferred payment guarantee first. When I will be tired, I'm just giving you a 5 minute break because I need break. Okay. Once I am tired, I'm just giving you a break for some time. Okay. Because see, this will be according to my tiredness. Okay. Everyone, no issues? Till now, everything is clear. Yes or no? Clear? Can we move forward to this deferred payment guarantee? Yes or no? Okay, now next thing. Deferred payment guarantee, very easy thing. Same thing, very easy. For example, A is a importer, B is a exporter. Okay, A want to import a very costly machine from B, and instead of an immediate payment, B just divided that amount into a monthly installment for 5 years. Okay, now A, because the amount is very big, A want a guarantee. So on behalf of B, B's bank is giving guarantee to A that in case if any EMI is missed by this exporter, okay, if any EMI is missed by this importer, okay, then I am responsible for making the payment of on the behalf of importer to exporter. Then if this is known as a deferred payment guarantee. Okay, so deferred payment guarantee is actually given on the behalf of importer by the importer's bank to the exporter, that if there is any EMI which is missed by the importer, okay, then on the behalf of the importer, that EMI will be fulfilled by the bank. That is called as the deferred payment guarantee. Okay, next. What are the method of payment? Deferred payment guarantee. First of all, for example, the machine value is 50 lakh. Okay, for example, first thing is the importer has to make 10 to 15% advance for that good. Okay, so from 50 lakh, the importer has to make the payment of 10 to 15% as an advance payment. Okay, now another 10 to 15% is payment is made when they actually receive that machinery and receive that letter of credit. Okay, because importer and exporter is there, so obviously for executing the transaction, letter of credit should be there, right? So once everything is executed as per the letter of credit, okay, another 10 to 15% payment has been made by the importer to the exporter. Okay. Now, whatever the rest amount is left, that rest amount is actually distributed into installment, and that installment can be paid with a period or repayment period between 1 to 7 years, and that is actually accepted, or that is actually secured by a deferred payment guarantee. Clear? Now, method of payment, when we are talking about the deferred payment of guarantee, obviously deferred payment of guarantee is not only for the principal amount, it is also for the interest amount. When the time period is given that, okay, rest of the, for example, 70% of the payment is left, and that you should be paying for 3 years in a monthly installment, obviously there is some extra interest on that. So the guarantee is not only for the principal amount, but it is also for the interest amount. Okay, now, here there is no guarantee of the quality of the goods. In a deferred payment guarantee, the deferred payment guarantee is not given to ensure the quality of the good. The quality of the good and these things are the letter of credit thing. Okay. Deferred payment guarantee is only given that if the importers default on any EMI, the EMI will be fulfilled by the importer's bank, right? That is the deferred payment guarantee. So it is actually only for the timely payment of the EMIs. It is not a guarantee of quality. It is not a guarantee of anything. It is just unconditional and irrevocable. Means bank has to give the payment if the importers default on payment. Okay, and if for example importer haven't received a good quality of product, now importer calls to his bank, says that I am not making the payment, you also don't make the payment. Now this is not acceptable, because here the importer bank says that the deferred payment guarantee is irrevocable and unconditional. It means that I have to make the payment to the exporter, okay, because it is a legal contract. So I have to make the payment. Okay, the quality, the quantity, this is not my criteria. I'm not responsible for any of these. I have given guarantee only for the payment, so if you default I will be paying. Okay, that quality and quantity, these are all the judgments that you have to take under the letter of credit. Okay, I am only just giving an irrevocable and unconditional assurance to the exporter that if importer defaults on payment, I will be responsible for making the payment. That is the deferred payment guarantee. Clear? Very simple, very short chapter. Any doubt in the whole chapter? Any doubt in the whole chapter? Very simple, very short chapter. Any doubt in the whole chapter? Kindly ask everyone. Any doubt? Yes or no? Shirish, no doubt. Everything is clear. Good. Now, next, let's talk about the next thing, laws relating to bill of finance. Okay, Shirish, after this unit, I will be giving you break, right? So don't worry. Laws related to bill finance. First of all, laws related to bill finance, we are just talking about the Negotiable Instrument Act. Okay, so Negotiable Instrument Act, first of all, Section 5 of Negotiable Instrument Act defines what is a bill of exchange. So bill of exchange is actually what? It is a written instrument containing an unconditional order that the seller has executed on its buyer, that you have to make the payment. That is called as the what? Bill of exchange. So bill of exchange, A has sold goods to B, instead of immediate payment, demands a time period for the payment of this transaction. So A agrees. A just draws a bill of exchange on B, saying that you have to make me the payment after 30 days. That is called as the bill of exchange. Now, who is making the bill of exchange? The drawer. Okay. Who is instructing buyer, which is actually the drawee, that you have to make the payment. And the one person who is entitled to receive the payment is called as the payee. So if A is instructing B that you have to make me the payment, okay, so A is the drawer also, A is the payee also. Now for example, A is instructing B that you have to make payment to C. Now, in this case, A is the maker, A is the seller of the goods, A is the maker, A is the drawer. B is the drawee, means buyer, who is actually given the instruction that you have to make the payment. And C is the payee, the one person who is entitled to receive the payment. Okay, so here there is a drawer. Drawer means the seller. Okay, seller who is making the bill of exchange. There is a drawee who is actually the buyer, to whom the instruction is given that you have to make the payment. And there is a pay, the one person who is entitled to receive the payment. Sometimes the pay and drawee can be the same person, sometimes they are the two different person. Okay, next. Now there are some important terms. First of all, the holder. Section 8, sections are important. Every point has sections you have to learn. Okay, now holder, section 8 is actually telling you that the holder of the bill of exchange is actually the person in whose name, or whose name is actually mentioned in that bill of exchange, and who is entitled to recover the amount in the bill. So if there is any particular name which is mentioned in the bill of exchange, that this is the person who is entitled to receive the payment, he or she is called as the holder of the bill of exchange. Okay, now holder in due course means a person who for consideration become the possessor of the bill. It means that, for example, A is the holder of the bill of exchange, means A is entitled to receive the payment. Now A want immediate payment, so A for consideration sell this bill of exchange to a bank and secure immediate payment. Okay, now here bank become the holder in due course. It means that bank is the one who actually for consideration receive the entitlement of that bill of exchange, means to whom the bill of exchange is actually transferred. Now bank is responsible for receiving the payment, so that is called as the holder in due course, section 9. Payment in due course means payment in due course is defined under section 10, which is saying that the drawee has to make the payment as per the apparent tenor. Apparent tenor means whatever mentioned in that bill of exchange, the name, the amount, the time period, in good faith without any negligence. That is called as the payment in due course. Negotiation means when the bill is actually transferred to another person, when that person become the holder in due course, so the process is called as the negotiation. When the bill is transferred to another person, that is called as the negotiation, right? Endorsement. Endorsement means if the holder signs the bill of exchange for the purpose of transferring it. I am the holder of the bill of exchange. I just sign that bill of exchange and mention a name that now this bill of exchange is actually transferred to this person. The process is called as negotiation. The person become the holder in due course, and when I'm signing that bill of exchange, that is called as the negotiation. That is known as section 15, right? Now, liability of the drawer. What is the liability of the drawer? Means the maker's responsibility. For example, actually draws a bill of exchange on B that you have to make the payment to C, right? Now, B is entitled to make the payment to C. Now, if B defaults on payment, B defaults on payment, then who is responsible for making the payment to C? A is responsible for making the payment to C. So now there is a liability, there is a secondary liability of a drawer, that if B does not make that payment of bill of exchange, then obviously A is entitled to make the payment. Okay. Now the liability of the drawee. There is the primary liability of this person. Drawee means the buyer, that you have to make the payment. Primary liability is of drawee and secondary liability is of drawer. Okay. Now there is a liability of endorser also. Endorser means, for example, C has endorsed this bill to D. Okay. Means B has to make payment to D. Now, if B defaults on payment to D, who is entitled to make the payment? C, right? Now, D endorsed this bill to E. Now, B is responsible for making payment directly to E. Now, if B defaults on payment, who is responsible for making the payment? D. So, every subsequent endorser has the liability to make the payment until the full debt is clear. That is the liability of the endorser. Interest rate is specified. So, yes, if there is expressed interest rate which is specified on the bill of exchange, that interest rate should be paid for that specific period of time. That you, if the seller has given a time period of 30 days, that you have to make the payment for after the 30 days, and there is a particular rate of interest which is mentioned. So after 30 days, B is entitled to make the payment plus the interest which is mentioned. And if the interest is not specified, it is 18% per annum. So 18% per annum interest should be paid if there is no exclusive interest which is mentioned on the bill of exchange, right? Now, there are different types of the bill of exchange. Now, just I'm switching off the camera so that you just see the content carefully. Now, classification of the bill. First of all, there is an inland bill. Inland matlab domestic. Inland means domestic. Now, what is inland bill? Inland bill means where the drawer and drawee both belongs to the same domestic boundary. Means the bill is drawn inside India and executed on the person which is the resident of India. Means both are within the same domestic boundary. That is known as the inland bill. Okay. Bank guarantee bill of exchange. There is a difference between bank guarantee and bill of exchange. Bank guarantee means A has given loan to B on behalf of B. C means bank has given guarantee to A that if this defaults on payment, I am responsible for making the payment. This is a loan. This is a bank guarantee. Bill of exchange is actually, A is a seller who sold goods to B. Now B want a time period to make the payment. Now A says that, okay, so A draws a bill of exchange on B saying that you have to make the payment of this transaction to C. C is the payee, B is the drawee, A is the drawer. That is known as bill of exchange. So guarantee and bill of exchange, these are pole apart. There is no similarity between these two. So we don't have the difference in these two because there is not even a single similarity in the bill of exchange and the bank guarantee. Okay, Gopal. Now there is a foreign bills. Now what are foreign bill? It is inland if the country is executed in another country than their own. Inland if other countries person execute in another country. No, it is not inland. Inland means when the drawee and drawer, they both belong to the same country. Okay, then it is an inland bill. Foreign bill means when there is a bill which is drawn outside India but make people inside India. Okay, so there is a bill which is drawn outside India and make people to the any person which is residing outside India, or there is a bill which is drawn outside India and make payable to the person in India. They both are the category of the foreign bill. If the bill is drawn outside India and are paid to any person which is outside India, that is the foreign bill. Or if the bill is drawn outside India and is made to a person who is the resident in India, then it is also a foreign bill. Okay. Now, demand bill. Demand bill means when there is no specific date which is mentioned. There is no date mentioned in the bill of exchange that you have to make payment after 30 days, 40 days, or on 15th of June. Nothing. When the payment is made actually on demand, means the drawer is saying that whenever I demand, the drawee has to make me the payment. Okay, then it is known as demand bill. Means there is no time for the payment which is mentioned, and the bill which is payment on demand, that is called as the demand bill. Section 19. Usance bill. Now, usance bills are the bill which normally contained a time period for the payment. Means, for example, the bill of exchange says that you have to make payment on 15th of June. You have to make payment after 30 days. Okay, that is called as the usance bill, right? Now, this is also called as the bill payable after size. Means you have to see and then you have to make the payment of that bill. And you have to make payment, you have to specify the time period for which the payment should be made. There is a particularly maturity or due date, then it is called as the usance bill. Okay, and where there is no date mentioned, then it is called as the demand. Okay, now clean bill. Clean bill means when there is no supporting documents needed for receiving the payment. Only bill of exchange is enough to receive the payment from the drawee, then it is called as the clean bill. Clean bill means the pay don't have to present any other documents for the payment. They only have to present the bill of exchange, and that document is enough for receiving the payment. That is called as clean bill, which is not supported by any documents. But there is a documentary bill. Now, what is documentary bill? Where the bill of exchange is not enough to receive the payment. Now, the payee has to show some other documents along with the bill of exchange to receive the payment. Then it is known as documentary bill. Now, in documentary bill, there are two type of bill. The bill which is drawn with the instruction to deliver documents against payment, means DP bill. DP bill means delivery against what? Delivery against payment bill. And there is a DA bill, means delivery against acceptance bill. It means that what? In a document, in a DP bill, means when the bill are actually drawn with the instruction of documents against the payment bill, it means that there is a party, a seller, okay, and a seller has given instruction to the banker that once once you receive the payment for that bill of exchange, because it is delivery against payment, it means documents against the payment, it means that once the banker or the bank receives the payment for that bill of exchange, after receiving the payment, the different documents like the bill of lading or the railway or the lorry receipt, then these documents should be delivered to the particular buyer. It means that once, if it is a DP bill, means document against the payment bill, it means that what? It means that once there is a seller who just instruct their bank that once you receive the payment, okay, of that bill of exchange, then only you will just submit these documents or just give these documents to the buyer, then it is known as DP bill. Okay, documents against payment. But there is a DA bill also. DA means document against acceptance or delivery against acceptance. Now, here the seller is instructing the bank that once The buyer accepted that bill of exchange. Now, here you haven't received the payment. Seller says that once the buyer just accept that bill of exchange, that yes, I am responsible for making the payment. As soon as the buyer accept that bill of exchange, you deliver all the supporting documents to the buyer. Then it is known as document against acceptance. It can be called as document against acceptance or delivery against acceptance. It can be called as document against payment or delivery against payment. That is called as the documentary bill. Now, if you have any doubt here, kindly ask everyone in the whole chapter. Any doubt in the whole chapter? If you have, kindly ask everyone. Gopal, Shirish, Ruchi, Hema, anyone. If you have any doubt, you just feel free to ask your doubt. Or just give me a thumbs up, everyone. Clear? Everything is clear? Okay. Now, just we are taking a 5 minute break and then we are starting this priority sector analysis. Okay, everyone, we are just taking a 5 minute break and then we are starting. Okay. Okay. I'm audible now, everyone. Ruchi, Gopal, Shirish, Hema. Audible? Audio, video, everything is clear? Yes or no? Okay. So am I audible to everyone? Right. So let's talk about the next chapter. Okay. And the next chapter is the priority sector advances. First of all, if you talk about the priority sectors, you know that all those sectors which are given priority over the other sectors because they are very crucial for the development of the economy, plus they are actually a very essential part of the people. Okay, then it is called as the priority sector. And the priority sectors, these are identified by Reserve Bank of India. A normal target of 40% of the lending ratio is given to every bank for achieving in the priority sector lending. It means that every bank has to give at least 40% of their total lending, especially in the priority sector. Now, when we are talking about the priority sectors, what are the identified priority sector? There are eight identified priority sector. Okay, what are these eight sector? Agriculture, MSME, export credit, education, housing, social infrastructure, renewable energy, and others. These are the eight priority sector. And if the lending loans has been given to these sectors, these are called as the priority sector lending, right? Now, when we are talking about the priority sector, the targets has been given. First of all, if we talk about the domestic banks and all those foreign banks in which the total have 20 branches and above. Okay, for them, the total target which has been given to them for lending in the whole eight priority sectors are 40% of the adjusted net bank credit or the credit equivalent of balance sheet exposure, whichever is higher. Okay. Now, if you are a foreign bank which have less than 20 branches, the target is again the same 40% of ANBC or COBE, whichever is higher. Then, if you are a regional rural bank, 75% target is given. 75% of ANPC or CEOB, whichever is higher. And if you are a small finance bank, again, 75% of ANPC or COBE, whichever is higher. Okay. Now, especially in the agriculture sector, for normal scheduled commercial bank and all those foreign bank which have 20 branches and above, 18% is target which is given. It is not applicable to the foreign bank which have less than 20 branches. If you are a regional rural bank, again 18% of ANBC or COB, whichever is actually higher, and 18% again for the small finance bank. Micro enterprises 7.5% total. For the scheduled commercial bank, 7.5% for the RRBs also, and same for the small finance bank also, not applicable to the foreign banks which have less than 20 branches. Advances to the weaker section 12%. It is not applicable here, 15%, and here it is 12%. These are the target, these percentage you have to learn. Okay. Now, there are small and marginal farmers. Now, who are the small farmers and who are the marginal farmers? So when we are talking about the small farmers are those farmers which have the land holding of more of less than 1 hectare. Just a second. Okay, just a second. So if we talk about the marginal farmers and the small farmers, so I always confused myself in this. So small farmers are those farmers which have the holding of 1 hectare to 2 hectare, right? And marginal farmers are those farmers which have less than 1 hectare. Kindly recheck it. Okay, I may be confused in these two, but you can just check it. So small farmers are from 1 to 2 hectare and marginal farmers are less than 1 hectare. Maybe it is interchanged, so kindly just recheck it once. Okay. So what is the current target which has been given given to small and marginal farmers. It is 10% for the year 2023-2024, and for weaker sections these are 12% target which is given for lending. Okay, now next thing, when we are talking about the agriculture, so there are 8 identified priority sector. Let's talk about each and every priority sector. Like first of all, agriculture. Now agriculture means when the loan is given to any individual to any of the agriculture plus allied activities like fishing and any those primary sector, these are all covered under the farm credit. Okay, there also include the infrastructure, means if you are receiving the loan for agriculture infrastructure, the ceiling is rupees 100 crore. Okay, ancillary services, like if you are taking loan for food and agro processing and other specified purpose, also this is also included in agriculture. Then there are some specified deposits with the Nabard and small and marginal farmers. These are all included in the agriculture sector. Okay. Now MSME, micro, small and medium enterprises priority sector, right? So factoring transaction on with recourse basis where the assigner is MSME. So in trades, there is a trade which is an online trading platform which is actually for all that bill of exchange which are actually drawn by the seller who is especially micro, small or medium enterprises. Okay, so for discounting the bill of exchange, if they are drawn by MSME on its buyer, there is a particular online platform, trading platform which is known as Trades. And here there are three participants. MSME who are the seller, buyers, normal buyer, and there are different bank and financial institution. Now the thing is, if any seller which is the MSME and they have a bill of exchange and they want immediate payment, they just registered their bill of exchange in this platform. Okay, now if there is any bank or financial institution which are interested for giving immediate credit to seller on behalf of that bill of exchange, they can do so, and they just provide credit and just take that bill of exchange. Now when the times come, this bank or financial institution recover the money from its buyer. Okay, so this is actually the factoring transaction which is actually done on the trade platform. Okay, now this is again a type of loan which is actually given to MSME. Housing. For housing, yes, it is again a priority sector advances. Now, housing loan, it is granted up to rupees 35 lakhs in metropolitan center. So, if you want to build or construct house, up to 35 lakhs as a loan is given to the individual in metropolitan center if they have a population of above 10 lakh, and these are treated as the priority sector advances. Okay, now, who are included in the weaker section? So, these are the categories of the weaker section. So, if the bank is giving loan to small and marginal farmer, artisan, village, cottage industries, if you are a scheduled caste or you scheduled tribe, self-help group, distressed farmers, okay, person with any disability, minority committee, then you are all coming under the weaker section categories, right? So, this is the priority sector thing. The most important thing related to the priority sector, the whole chapter I have already given you the details, okay, in that video. Kindly go through that video. It is just the most important part of this topic. If you have any doubt here, kindly ask. Everyone, if you have any doubt, just please ask. If you have any doubt, just ask. And if you don't have any doubt, kindly just give me a thumbs up. Everyone, any doubt? Yes or no? Ruchi, Shirish, Hema, and everyone, if you have any doubt, please feel free to ask your doubt. No doubt, everything is clear. Good. Now let's talk about the agriculture finance. Okay. So agriculture finance, first of all, under agriculture finance, Kisan credit card is very important. So Kisan credit card is issued for the farmers for providing them the immediate credit if they want. Okay, so for providing them the adequate and immediate and timely credit, Kisan credit card is actually offered. to the farmers, and it is offered for the purchasing of inputs, investments in the allied or non-allied activities. Kisan credit card is issued for the period of 3 years and it is annually reviewed. Okay, you have to make it review on an annual basis. Okay, so if the farmer has up to 1 hectare, they are the marginal farmer, and if they have 1 to 2 hectare, they are the small farmers. Right? I have just given you the right details there. Okay, now Kisan credit card, under this there is a flexible limit of 10 to 50,000 which is given, and it is based on your land holding. So if you have more land holding, there is more limit that has been given to you. And for what purpose the Kisan credit card is used? It can be used for post harvest warehouses storage, for other expenses, consumption needs, small term loan investments, anything. For any of these activities, Kisan credit card is offered to you. Okay, now the limit is actually for the 5 years and this is subject to the review. Okay, so if you have actually fulfilled all the criteria of the Kisan credit card, then your limit can be enhanced after the 5 years. Now, Kisan credit card facility or this credit card is also used for animal husbandry and fisheries thing. Bank also provide credit to the animal husbandry and fisheries. You can use for these purpose also the Kisan credit card. Okay, now there is a margin and security. No, this thing I have given detailed explanation. Okay, detailed explanation in the video, right? Everyone, kindly refer to the video for this detailed explanation. I'm not touching it here because I don't want you all to confused in this particular thing. That what is hypothecation of crop, when the collateral is required, for what limit it is required. This is very important. Plus, this I have just taken 15 to 20 and 25 minutes to just explain this particular slide. So just take time and go through this margin and security thing in the Kisan credit card, right? So you will see the video, recorded video, and just take time to just understand these margin requirement there. Okay, now next, farm mechanization, very important. Now farm mechanization is actually when the things or when the loan is actually given for the enhancement of technology. So if you are buying any machinery like power tiller, thresher, harvester, sprayer, duster, anything for increasing the production or productivity of your farm, you are purchasing the tractor, you are purchasing the harvester. But whatever machinery, in whatever technology you are investing, this actually leads to the increase in production or productivity. That is called as the farm mechanization. Okay, now if the farmer has minimum 5 acres of land that is perennially irrigated, it means that it is irrigated for a long period of time, and you should have a minimum 5 acre of land, then it is recommended to use the tractor. So if you have less than 5 acre of land, tractor is not recommended to you, right? So you should have a minimum 5 acre of perennially irrigated land for the use of tractor under farm mechanization. And bank also finance for the second hand tractors also, right? The repayment time period under the farm mechanization is from 3 years to 9 years, and the small and marginal farmers, they are actually encouraged to use the power trailer instead of the tractor because they have less holdings of 5 acre. So there is the farm mechanization where the loan has been given for increasing the productivity and production of your particular area, right? Then for this farm mechanization is used. Okay, now there is a minimum support price. Minimum support price is actually a price which has been announced by the government, saying that if, for example, due to any reason like increase in the supply, due to any reason, the price of a particular crop actually falls drastically, then for securing the profit of the farmer, the government is saying that we will be purchasing the whole crop at a minimum price in which the farmers is able to recover their profit as well as the money of that particular harvesting. That minimum price is called as the minimum support price. And who is the nodal agency for that minimum support price? That is the Food Corporation of India. Perennial means that is actually irrigated for a long period of time. Perennially irrigated means that is continuously irrigated for a long period of time. That is not left in an ideal position continuously. That is perennially. Okay. So minimum support price. Who is the nodal agency? Food Corporation of India is a nodal agency for that minimum support price. Okay. So minimum support price, Gopal, see that. For example, there is a crop like wheat. Sometimes the production of wheat is so much and the supply rises so much that it actually reduces the price of a crop to very low level. For example, at 1 rupees kg, 2 rupees kg. Now, at this distress sale, at this particular sale, if the wheat is sold at rupees 1 per kg, farmers is not able to recover the bare minimum cost of their harvesting, right? So at this point of time, the government is saying that I'm announcing a particular price. That if that if the market price of a particular crop falls below this price, then the government will be purchasing the whole crop at this minimum price. That is called as the minimum support price. This minimum price is actually a price in which is given by the government to the farmer so that they are able to recover the money from their crops. That is called as the minimum support price. And which is the nodal agency for the minimum support price? It is the Food Corporation of India, right? And there is NAFED, National Agriculture Cooperative Marketing Federation of India, which is actually an agency for procuring oil seeds and pulses if they falls below the MSP. So if the oil seed and pulses for them the prices is below the MSP, then National Agriculture Cooperative Marketing Federation of India, this is actually an agency for buying the oil seeds and pulses at a minimum support price from farm. Okay, that is the MSP. Okay, now there is a Prime Minister Fasal Bima Yojana. Prime Minister Fasal Bima Yojana is actually for providing insurance to the crop of the farmer. And this actually started in 2016. There are two basic covers. There is a basic cover and add-on coverage. Basic cover means if you are a farmer and you have enrolled in the Prime Minister Fasal Bima Yojana, then some basic cover has been given to you. That if, for example, if you suffered any loss during the time of harvesting or sowing, okay, then the crop insurance will be actually compensating your loss. Okay, and there is some add-on coverage. Add-on coverage, these are optional for farmers. So if they want to opt it, they have to give some extra money for these add-on coverage. Okay. So this is actually to provide insurance to any loss if it happens to the crop of the farmer. Basic cover, it is given to every farmer who have enrolled under this scheme. And there are the add-on coverage. Add-on coverage means those coverage which are actually for preventing any further loss over and above the basic cover, but it is optional to the farmers whether they want to avail it or not avail it. Now, what are the exclusion under this Pradhan Mantri Fasal Bima Yojana? So, if the loss are occurring out of any war, nuclear risk, malicious damage, or other preventable risk, then these are excluded from the Prime Minister Fasal Bima Yojana. And Aadhaar is required for availing the crop insurance. So, this is Pradhan Mantri Fasal Bima Yojana. Any doubt in this, guys? Any doubt in this? Yes or no? If you have any doubt, kindly ask everyone. Any doubt? No doubt. Now, see, this is the last unit, that is the self-help group. Okay. Now, self-help group, what is a self-help group? It is a voluntary association of those people who belong to the same social and economic background. Okay. And in the self-help group, every member of the self-help group is actually saving some money to this group, and this money is lent to any of the member of the self-help group in the time of need. That is called as the self-help group. Now, when we are talking about the formation of a self-help group, normally a self-help group has 10 to 20 members. If it has more than 20 members, then the registration of self-help group is compulsory. Otherwise, the registration is not compulsory. And in some hilly or desert areas, the member can be only just 5. Okay. Now, what are the income criteria? Every member should technically falls below the poverty line. Okay. But in some exception cases, if the members are over and above the marginal or over and above the poverty lines, right? They should be marginally above the poverty line plus only 20, and max to max, exceptionally 30% members are only allowed who are above the marginal poverty line. Rest the members should be below the marginal poverty line. Okay. Subsidy, BPL, only those members who are below the poverty line are eligible for the subsidy under this self-help group. Management, those who are below the poverty line, those members should be responsible for managing the self-help group. Okay. Restriction of the membership. One member, one family. It means that one family, from one family, there should be only one members in the same self-help group. Okay. And a member should not be a part of more than one group. So if I am a part of one self-help group, I cannot enroll myself in another self-help group. Okay. There should be a proper code of conduct that is actually binding to every member of the self-help group. There should be a corpus. Corpus means every member of the self-help group is actually contributing and building up principal amount, which is known as corpus, which is lent to any member of that self-help group in the time of needs. Okay. Loan to member is given. Okay. Bank account, every self-help group should have a proper bank account, and that should be in a surface area bank branch. Okay. And the self-help group has to maintain some records, like they have to maintain minute book, attendance register, loan ledger, general ledger, cash book, bank passbooks, etc. So these are the records which the self-help group has to maintain. Okay. Now, there are some self-help group bank linkage program. Okay. Like for example, if you are opening the saving account, so self-help group, whether you are registered or not registered, they have to open a saving accounts in the bank. Okay. Lending to self-help group means bank is also providing credit to the self-help group in the ratio 1 is to 1 or 1 is to 4. It means that if the self-help group has a saving of rupees 100, bank can provide them a loan that can range from 100 to 400. Means if they have the saving of 100, bank can give them the loan of either 100 or 200 or 300 or even to 400, but not more than 400, right? But for some self-help group, if they are running from a very long period of time, the bank can provide them a loan of over and above 400 also. So the saving to the loan ratio can be 1 is to 1 to 1 is to 4. Okay. Interest rate subsidies are given. Plus, the bank are free to decide the interest rate, but as per the RBI guidelines. Okay. No processing and service charge that should be given on the loan if the loan amount is up to 25,000. Okay. That is the bank self-help group and the bank linkage program. So this is a very small chapter, self-help group. Now, we have some chapters left, like this unit 38, unit 29, unit 35, unit 40, and unit 39. So these are some unit which I have not touched here because this particular module B is actually very lengthy module. We have various chapters in this, but these chapters I have given you the recorded format. Plus, these chapters are only for the reading purpose. Okay, so you will not find any difficulties in these chapters. So you just read out these chapters from the recorded video. So this is it. This is what I have to give you from my side in this complete module B. Now, if you have any doubt here, please feel free to ask your doubt. Any questions, anything you want to tell, you want to say, you want to ask, just please tell me, everyone. Anyone? Ruchi, Shirish, Gopal, Hima, everyone. Nothing, everything is clear. Shirish, I have just given it in the PDF. Okay. 39, 40, 35, 29, and 38. Okay. These are given in the PDF. Don't worry. When you see the PDF, you will find that, okay, these are the chapter which we have to read. Okay. Shirish. So thank you so much, everyone. I hope that these two marathons are very beneficial for you all, right? And thank you so much. Thank you so much, everyone, for joining this session. Thank you so much. Have a very nice day. Okay. Take care, everyone. Okay. Have a very good night. Then meet you in the next class tomorrow morning session. Okay. Thank you so much, Shirish. Thank you, Ruchi. Thank you, Gopal. Thank you, Hema. Thank you, everyone. And it's a request, guys, that please, before going, just kindly drop me a feedback and ratings to the session. Everyone, it's a request. Please drop your feedbacks and rating to the session. Okay. What should be the strategy for adopted? See, Ruchi, this strategy I will be telling you in a one complete video. Whereas in YouTube ना मैंने बहुत sessions किए हैं about this strategy. You just message me on WhatsApp. I am sharing you the link of the video. You will just see the strategy that I have given to you for PPB, that in this way you have to prepare your PPB. Okay, I will share the link. Okay, just drop me a message, I will share the link. Okay. Okay, so thank you so much, everyone. Thank you, guys. Thank you. Take care. Have a very nice day. Thank you.